I used to be a passive index investor. I believed everything I was told. Just buy the index because active investors underperform their benchmarks over 90% of the time. Make sure you diversify geographically. Make sure you get some small companies, some large companies, maybe sprinkle in some bonds as you get older, and absolutely never try to time the market. But that was until my business partner and I discovered a better way, and it completely changed my mind. I'm Mitch, the founder of Strong Wealth, and I'm going to be breaking down our dynamic investment strategy, Fluvius. Fluvius has caused smart, skeptical investors that refused to pay 1% to anyone to manage their portfolio to completely change their mind. And no, I'm not advocating for picking stocks or day trading or selling options. We are a premier wealth management firm that just believes that financial advisors should be great investors for our clients, and this is how we accomplish it for ours. Right off the bat, many of you may be wondering what the name Fluvius means. It's kind of out of left field to a lot of people. The idea behind it is Fluvius is Latin for to flow. And with our strategy being a dynamic, active strategy, our clients' assets actually flow to where returns are coming from in the market, regardless of where that might be or in whatever asset class that might be. So let's go ahead and dive into the strategy itself. Before we get into it, though, here are just a few quick reviews, quick comments from our clients on what they had to say about their experience investing in Fluvius. So you can read here from Michael, our portfolio, particularly through their Fluvius fund, has increased dramatically in a relatively short period of time, which has been incredibly encouraging and reassuring. Number 2 here from Emmett, all this while delivering world-class results. So you can go read the rest of these reviews on our Google business profile. If you just go to Strong Wealth on Google, you'll be able to find, the rest of these specific reviews and some others in addition to those to really get a feel for what our clients have to say about working with us. And lastly, here's Fred. These guys are the best. They are blazing the trail into the next chapter of financial assets and planning. So I have to just disclose that, none of them were compensated for these reviews. Your experience might be different than other clients. And of course, past performance is not, guaranteed. It does not guarantee future performance. So just got to put those disclosures out there, but you can go read the rest of these publicly on our Google business profile. All right, so who is Fluvius for? It's important that if you're going to take the time to watch this video, we just make sure up front you can decide if this is for you or not so you don't waste your time. All right, so first, Fluvius is for you if you want to retire early or be able to spend more in retirement. You want a better strategy for your passive index funds / traditional assets that will actually protect you from rampant inflation and adapt to the current market. So a lot of people that we talk with, they have some Bitcoin that they've already acquired. They've got it in cold storage. They might hold it on exchange, something like that. But then they have another, bucket of their assets that's usually still in passive index funds or just other traditional assets. Maybe it's managed by an advisor currently, but you're just not happy with the performance, or you just don't believe that your portfolio is truly aligned with what you see coming. So this strategy, it can protect you from inflation, which we've seen just crazy inflation recently in the US. I think it's going to continue to happen as well. And this portfolio can adapt to what's going on in the markets, regardless of what that might be. Continuing on, this is for you if you want high growth without sacrificing downside protection and diversification. This is why I say it's for people who want to retire early or spend more in retirement, because it can provide higher growth than, the standard 60-40 portfolio that your traditional advisor might recommend. But we're not doing that, in sacrificing the downside protection and diversification that those portfolios might provide. We're just putting it all together into one strategy. Next, this is for you if you want to align your non-Bitcoin assets with the fourth turning we're living through. If you're not familiar with what the fourth turning is, you can do some more research on that. I'm not going to go into it here. Next, you want a portfolio to live off of in retirement without touching your Bitcoin stack. So oftentimes when people reach out to us, they really want Bitcoin to be their generational asset that they really never touch. They pass it down to their kids, maybe their grandkids. And so they need a portfolio that provides their retirement income. And this is where Fluvius can be a great fit, a great tool in the tool belt, if you will, for our retired clients. Lastly, this is for you if you want a strategy that's actually worth paying 1% for. So I oftentimes see a lot of people on X or other, just the internet in general, they'll say, why should I pay an advisor 1% when all they do is just put me in index funds? And, I used to argue against that perspective, but now that I've changed my mind and I kind of see clearly what's going on in the markets and have found a better way to do this, I agree with that, to be honest. I don't think you should pay 1% to somebody who just puts you in index funds and doesn't do anything else for you. All right, so you may have decided this is for you, so let's go ahead and dive into the rest of it. What is our fundamental thesis? Our thesis is that we are living through the final stage of United States dollar dominance and the fiat currency experiment that began in 1971 when President Nixon officially untethered the US dollar from gold. So we left the gold standard in 1971. Many people still don't even realize that yet today, even though we're over 50 years later now. The US dollar is not backed by gold like it used to be. Next, financial repression and monetary debasement are necessary evils of this financial system. You might be wondering, what do those phrases mean? Again, you can look up these phrases. Maybe you can ask AI and they'll be able to give you a breakdown. But in short, financial repression is basically the manipulation of our financial markets by the government to try to hide inflation or to hide other things, other problems that are going on behind the scenes. And then monetary debasement is simply money printing. The most recent example of that was during COVID in 2020 when, money was printed and checks were sent out to a lot of people across the country. Whether or not you think that was a good idea or not, at the end of the day, when you print a lot of money, you get a lot of inflation. And that's what we saw in 2022, 2023. That was the inflation that, resulted from the extreme money printing that we saw during 2020 and 2021. All right, so those are necessary evils of this financial system. Why do I say that? Because they are almost forced. The system reinforces this behavior regardless of who is in charge. And so no matter who it is, whether it's Republican, Democrat, doesn't matter, they're going to have to continue to act in such a way that keeps the system afloat. If they don't, it will collapse under its own weight and we have much bigger problems than these problems. But these are major problems for investors, especially those who are entering retirement soon or maybe already in retirement. All right, so those are the greatest risks to your portfolio for the foreseeable future. Nominal growth may appear normal. What I mean by that, if you don't know the difference between nominal and real, nominal is just the growth of assets when you're not factoring in inflation. And so things may appear normal on the surface. Your bonds might look like they're going up in value. Your stocks might look like they're going up in value. Your account might be increasing. But the thing is, if you're not comparing that to what that portfolio actually provides you in your lifestyle, then it might not be really increasing, which means it's underperforming inflation, which means you can't, go to the grocery and buy the same amount of stuff. You're not able to achieve the goals you have in retirement. You might not be able to buy that dream house. You might not be able to pay for your grandkids' college or whatever else, whatever other goals you might have. So nominal growth may appear normal, but real growth is what matters, meaning dollar gains are good only if those dollars buy us more real goods than they did previously. Volatility is expected and should largely be accepted because it will inevitably resolve itself with higher asset values as we navigate the remainder of this transition period to a new global order that will establish fresh rules for the next 100 years. So this is hinting at the, uneasiness that you might feel just in global markets, the economy, tensions between countries and the US. There's a lot of things that are shifting right now, and that is common among fourth turning time periods. So if you do some research on what the fourth turning means, you'll find that this period of time is when a lot of global economic shifts are likely to happen. And we've already seen them happen, over the last 5 to 10 years, should last, anywhere from 5, 10 to 15 more years that we'll be living in this type of time period until we establish what things are going to look like in the future. All right, continuing on here. So that's our fundamental thesis on just where things are headed in the world in general, and then how we align our investment strategy along with that. How do we go about taking advantage of what we see going on in the world and believe about the future? So, in our opinion, trend and momentum strategies can outperform market indices over long periods of time, and that is the best approach to capture superior risk-adjusted returns in this financial environment. I should say that it's our opinion that this is the best approach. It's not our opinion that this first line is true, that these strategies can outperform market indices over long periods of time. I'm going to show you some specific research and data to back that up. So you can see that here in Exhibit 6. This is from a paper written by Meb Faber. If you're not familiar with him, you can do some research on him. Even got the specific paper down there, the source of this. But what this is showing you is actually, trend and momentum strategies can outperform just buy and hold strategies. So these numbers are reflecting the performance of using a momentum strategy compared to the S&P 500. And so all that it's showing is that if you decided to buy the top performing sector over the previous 12 months and hold that sector for the next month and then do it over again, you would have experienced this average outperformance over just buying and holding the S&P 500 over all of these decades going back to the 1930s. So this is over 100 years that these strategies have shown the ability to consistently outperform the market and specifically outperform the S&P 500. So what this paper did was look at the 6 primary sectors of the S&P 500. Then they calculated the performance over the prior 12 months, and whichever sector had performed the best, that's the sector they decide to hold for the next month. And then every single month, they rerun that analysis, look back at the last 12 months, and they hold the highest performing sector. So obviously that can change if one sector takes the top spot over another, or maybe the same sector continues to be held over time if it continues to be in that number one spot. And so you can see here, top 1, top 2, top 3. What this is showing you is that if you just held the top 1 sector, this was your relative outperformance. If you held 2 of them, top 2, this was your outperformance, in top 3. You can see it diminishes over time, but the point remains the same of these types of strategies have consistently shown the ability to outperform just buying and holding the market overall. And these are very simple. Again, this is not picking stocks. This is looking at sectors overall. Of course, back in the day, back in the 30s, 40s, 50s, all of these decades, you didn't really have a way to easily do that. You had to buy all these individual stocks in order to do it. Nowadays, we have things like ETFs that track sectors and make it very easy to implement one of these strategies. So let's go ahead and continue on. This is just some more proof that momentum strategies work above just buying and holding and passively index investing. So you can see here on the left-hand side in this figure 3, this is tracking the percentages of profitable months across all of these asset classes. So, this is showing just equities in specifically sectors within the S&P 500 and employing this type of strategy. This is showing that this performance holds across all different asset classes. So you can see here US stocks, if you utilize the same logic that I just shared before, and you just decided to hold the top performing sector, that's performed the best over the last 12 months. And then if it had underperformed T-bills, you just don't hold over that time. And so you can see here, US stocks, percentage of profitable months, well over 70 versus just no momentum, no strategy at all, just buying and holding, AKA passive indexing. This is percentage of profitable months, a little over 60. So big jump. And you can see here across all of these asset classes, whether it's international, emerging markets, T-bonds, credit, high yield, real estate investment trusts, commodities, or gold specifically, the green bar, the dark green bar specifically, is higher in every single asset class. So that tells you that implementing one of these absolute momentum strategies can easily outperform just buying and holding. Again, every passive investor, every advocate for passive investing tells you it's so hard to outperform the market. If that was true, then why does this data show something otherwise? Why does this show consistent outperformance above just buying and holding over decades, over centuries? I mean, this previous chart here shows that this outperforms in every single decade going back to the 30s. to the 30s. That is 100 years of data. This is showing 74 to 2012, and it's the same story. Utilizing one of these strategies gives you consistent outperformance over just buying and holding. Nobody shows you this, and I didn't know this until I actually dug in and figured this out for myself. Here you can see on the right-hand side, this is also better drawdowns. So not only do we get better performance to the upside, as we showed in the last two charts, we get better performance to the downside as well, which is just crazy. You can see here, utilizing an absolute momentum strategy on US stocks, international emerging markets, again, across all the asset classes, story is the same. Maximum monthly drawdowns over this 40-year period, utilizing a momentum strategy. You get lower drawdowns in every single asset class across this entire study. So if that's not proof enough, here's just a few more supporting data points for trend and momentum strategies and their efficacy as an active strategy to be able to outperform just simply buying and holding. So you can see here from John Lewis, he wrote his paper on relative strength and portfolio management. January 2010 is when he published this. There has been so much research showing that momentum works that academics no longer dispute its value as an investment factor. Continuing on, this is Paul Tudor Jones, one of the best hedge fund managers ever. If there was a strategy that I would want to employ right now, if someone put a gun to my head, I'd say simple trend following strategies. They're not too popular today. They will probably do very well in the next 5 to 10 years. This is 2022. Personally, I think we have a little bit more runway than what he's referring to, but story remains the same. All right, last point here from AQR in one of their recent papers as well on this, the evidence of trend following investing. It says trend following investing has performed consistently over more than a century, as far back as we can get reliable return data for several markets. This is proof that what we're doing here at Strong Wealth is not reinventing the wheel by any means. I'll share what makes what we're doing unique to what I've already shown you. But the point is that this is proof. This way of investing, this strategy has performed over all different types of market environments, regardless of what's going on in the world and the economy, who's president, doesn't matter. Regardless of who's Fed chair, this works. Continuing on here. So what makes our strategy unique? Obviously, I've shown you some data behind other strategies. And so it's like, well, why wouldn't, everybody else just do that? And, to answer that, I don't really know why, but at the end of the day, I'm not going to, regurgitate something that someone else is already doing. I want to have my unique spin on things, so that we can provide the absolute best for our clients. So why is what we're doing unique? First, we created an independent sleeve structure to build a multi-asset class portfolio. So, the data that I showed you shows that these strategies work across different asset classes. We're bringing a few asset classes together in one portfolio, and we're doing that in, an independent way, which I'll get to in just a minute. So second bullet point here, we assigned unique trend and momentum logic to each independent sleeve because different asset classes inherently behave differently. So if we go back to this chart here, you can see this is looking at all these different asset classes and it's applying the exact same logic, which is shown to work. However, we recognize that, if these different asset classes, if they're trading differently, meaning their price action is differently, what if we crafted the logic to be unique to the asset class so we can get better performance by being more intentional and more specific? Turned out it works. Continuing on, we developed a proprietary risk management protocol to uniquely improve performance across uncorrelated assets and minimize out-of-market duration. I'll simplify that. This is some finance language here. What I'm getting to is that we have asset classes that are uncorrelated, and what most people do, which this is what this graph is showing, is when you're not holding, when you're selling, this is how you get improved monthly drawdowns. Whenever you're not holding that asset class, you're holding T-bills or you're holding cash or something that's just pretty stable, not really doing anything. For us, we recognize that, okay, if our thesis is correct, what I shared earlier with, high inflation, high money printing, high financial manipulation by the government, we do not want to be out of the market. We do not want to be out of assets that aren't growing for us. And so instead of just selling and going straight to cash, what if we get a sell signal and we look elsewhere for something else, another asset class, another asset that might be performing in the meantime? And that's what we built. Last includes Bitcoin as an investable asset class. I could have just put this bullet point alone, and that would have made it unique from anyone else in the entire industry. But we did more than just add Bitcoin. Continuing on here, what is this strategy designed to do? What are the features and benefits of this? So Fluvius is designed to systematically identify assets with strong momentum behind a positive trend. So what I showed you earlier is momentum strategies work. The idea behind it is that when things are in a positive trend, they're in an uptrend, and there's momentum behind that trend, it's likely to continue for some period of time. How long that is unknown, but it might be a long time, it might be a short time. But the point is seeing that something has a positive trend and momentum behind it is usually proof that the next month or the next few months are very likely to continue up for that asset class. And I've already shown you the data for that. So this strategy systematically identifies those assets. I don't have to wake up every single day and look at charts and figure out what's going on. This strategy is built to just take in the market data and decide what to do on its own. It's systematic, it's unemotional. It doesn't matter what I think, what my business partner thinks. We've crafted it to think for itself strictly based on the data that the market is telling us. Continuing on here, you can see the reason why we built this strategy and why these are so effective is so that clients can benefit from what's currently performing rather than passively holding everything and being at the mercy of the market. In my opinion, this is one of the biggest drawdowns of passive investing is you just try to hold everything and you're just like, well, I don't really know what's going to perform, so I'm just going to hold it all. And then what happens is you end up always holding a loser. You end up always underperforming by definition because you're holding winners and losers instead of just holding the winners while they are winning. An example is during the 2000s, we saw gold skyrocket while US stocks did nothing. For passive investors, they may have just held the US stocks and they had a decade of basically no performance. For people who passively held gold and US stocks, they underperformed because they had US stocks dragging an anchor in their portfolio. But if they would have had a trend and momentum strategy that actively adapted to the current market environment, they could have gotten performance from gold while it's performing and then shifted away from it when US stocks returned after the great financial crisis and have gone on a strong bull run. We've seen this between US stocks and international stocks, for example. There are decades when US stocks perform better versus international. There are decades when international perform better. And so what most passive investors decide to do is they just decide to hold both. But again, by definition, you're always holding whichever one is losing. But our strategy actively adapts to whatever's performing, that's what we'll hold until it changes. And when it changes, the market will tell us that. We don't have to predict the future. I don't have to have a crystal ball. I don't have to play God and try to figure out exactly what tomorrow, next month, next year, next decade is going to look like. This strategy adapts to it based on real market data. All right, continuing on. Protect client assets so that your money can get out during prolonged market crashes when our sell signals are triggered. So not only are we getting a strategy that adapts to what's performing, it also can produce sell signals to just get out if things are truly crashing over a prolonged period. This is not designed to catch every little dip. No, nobody can do that. A common phrase from passive investors or advocates of passive investing is that nobody can time the market. Nobody has a crystal ball. No one can predict the future. Yes, I agree with all of that. That's why this strategy is not built to catch every single top and every single bottom and be perfect. Not going to happen. Nobody can do it. This is designed to capture long-term trends. So if we're in a long-term downtrend, we can get out and protect our client assets. Continuing on, automatically adapt to the current market environment without clients needing to study financial markets or ever lift a finger. We're doing this strategy is doing all the heavy lifting. We're doing the heavy lifting for our clients and building it. Our clients don't have to watch the news, figure out what's going on. You don't have to question whether or not your portfolio is actively adapting to what's going on in the world. You have a portfolio that's working for you and that's figuring this stuff out on its own. You don't have to figure it out, or you don't have to rely on your advisor to stay up with it. And they might just tell you, well, it doesn't matter. We have a passive portfolio. But your portfolio can perform better if it actually adapts to what's going on in real time versus just burying your head in the sand and choosing to act like you have no idea what's going on, which in my opinion is passive investing. Continuing on, last thing here, benefit from the growth of Bitcoin, commodities, and equities without leaving clients completely vulnerable to extreme crashes. That's, Bitcoin volatility. We've seen extreme crashes. Commodities, we've seen extreme crashes. Equities, we've seen extreme crashes. Even, 2008 is a great example in the great financial crisis. COVID could maybe be one, even though it recovered super quickly. But again, these are quick, drawn out crashes that, can wreck your entire retirement. They can wreck your financial situation and wreck your portfolio. We can protect our clients without leaving you completely vulnerable. And we can get you growth from these assets without just passively holding and riding that roller coaster up and down. All right, next slide here. Fluvius is designed to provide high growth with downside protection and diversification. People often say high risk, high reward. I believe that this is a myth in investing to some extent. Let's be clear, to some extent. You have to take risk to get reward, but I believe that most people think that they have to take a crazy amount of risk to get high reward, which is why they end up just choosing to passively own index funds. I disagree with this. We want to give people high reward without unnecessary risk. Notice I didn't say no risk. You must take risk when you're investing, but we're not taking unnecessary risks. We're not picking stocks. This entire strategy is built on ETFs alone. We're never holding an individual stock. There's no reason to. You don't need it to get world-class results. Continuing on, benefit from the financial repression and monetary debasement that will destroy the real value of the dollar and fixed income assets. This is the biggest problem with retirement portfolios that I see from most financial advisors in our industry. They have way too many bonds. And that is out of the premise of these are going to protect us. But this is facade protection. This is faux protection. It's fake. It's not actually protecting you. All that it's doing is holding your portfolio back in bull markets just for the sake of having a little bit lower drawdown in bear markets. But we're seeing multi-year, even decade-long bull markets with just pullbacks along the way. So why do we need to hold so many bonds and just attach an anchor to our portfolio over that time? We don't need to. And the government is going to print so much money, the new Federal Reserve Chair, whoever Trump adds, if you're watching this later down the road and that's not relevant context, relevant information, point is, this period of time we're living in right now, and I believe over the next 5 to 10 years, we're going to see very high inflation. We're going to see the value of the dollar drop substantially over that time, and that is going to kill the value of your cash for one, but also your bonds. All right, next, not be solely dependent on Bitcoin for performance. A lot of people look to Bitcoin to be their sky-high performer, and it comes with a lot of volatility. And so what most people do, they're either scared to add Bitcoin to their portfolio for the sake of the volatility. They can't handle it, which this strategy protects against that. They add too much Bitcoin because they feel like they need more performance. They need more growth to protect themselves. And so they end up over allocated to Bitcoin. And then whenever Bitcoin does have a substantial crash or it doesn't perform like they expect, they're in a very bad way and they're not prepared for that. So this strategy is designed, again, not to be solely dependent on Bitcoin for performance. If Bitcoin's performing poorly, we have a mechanism to hold another asset class until we get a buy signal. It's a great way to pseudo increase your Bitcoin allocation when it's performing and hold other assets when it's not. We've encountered and talked with a lot of people that now work with us that they were hesitant to increase their Bitcoin allocation because they didn't, again, want to deal with the extreme crashes. So what this strategy does is this allows them to increase their Bitcoin allocation when it makes sense to, decrease it when it doesn't make sense to. All right, so let's get into the default models of Fluvius. These, again, are just for illustrative purposes only. You can see here at the bottom. This is not a recommendation to buy or sell anything, and your portfolio doesn't even have to match this if you decide to invest in Fluvius. My favorite is specifically the 3-sleeve strategy. We have the 4-sleeve here. It makes sense in some specific certain situations, although the fixed income portion, doesn't sit super comfortable with me, but we have it in there for people where it might make sense. So on the 3-sleeve strategy, it's 3 sleeves because we're utilizing 3 specific asset classes: commodities, equities, and Bitcoin. 4 sleeves over here because fixed income in addition to these other 3. Again, these are just the default illustrative models. This is not any recommendation for an allocation specifically. I just want to give you an idea for what the models look like and how the strategy works. Continuing on here, here's some more details about the strategy itself. We only utilize ETFs, no individual stocks. Like I said earlier, I'm not a day trader. I'm not trying to sell you some course. I'm not picking stocks. I'm not trying to sell options. I'm not trying to sell you something. We are utilizing ETFs strictly for this strategy because that gives us additional diversification, decreases our risk, but again, we're still getting high performance because we have a portfolio that actually adapts to what's going on and takes advantage of trends that we're seeing in the markets. Next, limited to monthly trades. Again, we're not day trading. We're not trading in and out all the time. This isn't some algorithm that's, running its analysis 24/7 and making trades. And, all of a sudden you have extremely high transaction costs. You have a ton of taxes at the end of the year and you made no money. That's not what's happening here. We are limited to monthly trades at most. And oftentimes a lot of, our signals are just hold. Don't do anything. Don't sell. Just hold the same thing for the next month. That's what we do. Next, each sleeve's investment holding is decided independently of the other sleeves. Again, this allows us to get better performance because we're not applying logic that might work for equities to Bitcoin or might work for commodities to equities. We specifically crafted it to get the most juice out of the squeeze of each of these asset classes. Next, we have unique downside protection mechanisms as well. So, of course, with different price action in different asset classes, you need to make sure that your sell signals are crafted for that asset class and not the others, because you want to make sure that you're getting, again, the most out of the growth, of those asset classes, but you're still protecting yourself from extreme drawdowns or prolonged bear markets. And then lastly, quarterly rebalancing. So whatever the allocations are at the start, whenever you start investing with us in Fluvius, we rebalance back to that on a quarterly basis. That is a systematic way. A lot of people are familiar with rebalancing, but if you're not, it's essentially a systematic way to buy low, sell high. Our highest performing asset classes, we're selling some, taking some profit off the table, buying our other lower performing asset classes with the idea that those are going to go up over time. And so we're buying low, selling high. This is a systematic way to get better performance out of your portfolio and lower the risk over time. All right, this is our proprietary risk management method. That's why it's completely blurred out here. If you want to learn more about this, I just can't share this publicly. There's a lot of work that went into crafting this strategy, and this specific thing right here is very unique to our strategy. I don't know anyone else, in the world maybe that's utilizing something like this with a strategy like this. So I can't share this publicly, but if you're interested to learn, what's behind this blacked out screen here, you want to learn more about the strategy itself, you can go to our website, www.strongwealth.net, schedule a call with us, and I'll be happy to share you what these details are so you can learn more about the strategy and see if it's right for you. Continuing on, how do we decide what to do in the Bitcoin sleeve? Hold Bitcoin, sell Bitcoin. What do? We use a trend filter. So this is a simple moving average. This white line here is a simple moving average. The gold line is Bitcoin's actual price. So you can see we're not trying to time perfect tops or bottoms of Bitcoin. That's why we have these red sell words and buy words. The green words indicate around the time that we would be buying and selling. As you can see from the chart, this allows us to capture the long-term trends. Bitcoin's a very cyclical asset. So why not take advantage of those cycles and see them coming and be able to capture most of the upside and avoid most of the downside? I'm not saying all the upside, all the downside, but again, this way, just using a simple trend filter allows you to do that. So that's what we do. A lot of people are surprised by the simplicity of how we decide whether to hold Bitcoin or not hold Bitcoin, but we have done our due diligence on more complex methods, and every single time we add complexity, it seems to hamper performance. It makes it worse. And so simpler the better. That's what we found. And again, this is like a year's worth of work going into crafting this strategy. And so we've done a due diligence on a lot of other things, even things that you might think, well, why wouldn't you do that? That seems logical, probably will lead to better performance. Usually doesn't. Continuing on, how do we decide what to do in the commodities sleeve? We start with ETFs. So we have our bucket, we have cash in there as well. And then we rank them based on their recent performance. So we look over a historical window. I won't share exactly what that is. Again, that's proprietary information. We can share more if you decide to schedule a call with us and see if this is a right fit for you. But we look at their recent performance. We rank them 1 to however many ETFs are in that sleeve. And then we just hold the 2 highest performing for the next month. Pretty simple. Again, a lot of people are surprised by the simplicity, but whenever you add complexity, it usually makes performance worse. And then you can see down there at the bottom, if a sell signal is triggered, exit commodities. I'm not going to share exactly what our sell signal is. Again, this is all proprietary information. I do not want to put this out publicly, for other people to try to steal or copy, whatever that might be. This is what our clients are paying us to do. So I can't share that publicly, so for everyone to go ahead and do for themselves. More proprietary information, schedule a meeting to learn more at our website, strongwealth.net. Continuing on, here's how we decide what to do in the equity sleeve. We start with the ETFs, we rank them, we decide to hold the highest performing for the next month. Seems super simple, straightforward. When we have a sell signal, we decide to exit equities. All right, fixed income. Again, I prefer the 3-sleeve approach over the 4-sleeve approach. So, not having fixed income at all, but, sometimes it makes sense for certain people in certain situations. But we have the same logic here. This is how we decide what to do. We start with our ETFs. And again, we've decided what these ETFs are going to be way in advance. We locked that in at the beginning of our strategy when we were doing this due diligence. It took us very long, a lot of hours in order to do this, and years of experience even prior to coming up with this strategy around investing, $100+ million for other firms. All right. I wish I could share the performance data of this, but we are a registered investment advisor. We're very limited based on our compliance laws, around what we can share regarding performance. So I can't share performance publicly, but I can share it one-on-one. So if you want to learn more, you want to see what the numbers are, how this thing has performed over the last decade, net of fees, and even for our clients who are invested in it right now, I can share that with you. But I can only share that with you in a one-on-one conversation after we figure out if this is suitable for you or not. So if you're interested in learning more after watching this, you can either email me, mitch@strongwealth.net, or the best way is just go to our website, strongwealth.net, schedule your free discovery call there. I'm happy to talk you through the details, figure out 1, if this is right for you, but 2, reveal the performance, because honestly, you can see here what our clients have said in their reviews. And every single time I talk to somebody, they are surprised by the results. They're surprised by the performance. They're intrigued by the performance. Those are the common responses that I get. Again, these reviews here, I just have to disclose, they're from Google Business Reviews. You can go to our Google Business profile and read the entire thing. We didn't pay them for these reviews. These are reviews from clients who are invested with us in the Fluvius strategy right now, who are loving the results that they're getting, and they're willing to share that for free just to be a fan of our business and help us grow. So if they're having a great experience, you can go read about the 20 others that have left us reviews as well. and I'm sure we'll have some more rolling in over time. But again, if you want to learn more about this, go to our website, strongwealth.net, schedule a call. You'll talk directly with me. I'll break it down for you and reveal the data that you really want to know, which is the performance. Thank you for watching. If there's someone you think that could be a good fit for this strategy, maybe it's not you, but your friend or your parent or whoever it might be, send them this video. They'll be able to learn how it works, and then they can schedule a call for themselves if they're interested. Again, I'm Mitch. I'm the founder of Strong Wealth, and we are a wealth management firm for Bitcoiners. Contact us if you'd like to learn more about our strategy, Fluvius.